Without further ado, though, we're going to get into our feature presentation here today. But first, a live read from Coach Mark.
I'd just like to give a somber message to our troops, those that have served previously, those that are currently serving. We at Tackle Trading have such a great respect, admiration. We have several students that are currently in the military or have served. We're allowed to have fun here on the podcast and talk about cash flow and financial things. And we're able to go to parks on the weekend, and we're able to live, when you think about it, like some of the highest quality lives that humankind has ever seen. Because brave men and women, previously and currently, do what they do to protect our freedoms, to protect us from individuals that would love to do us harm. And so we would just like to send out, in a time where the troops are certainly in the forefront of many millions of Americans' minds, our appreciation, our gratitude, our thoughts, our prayers for your safety, for your family's peace of mind, and just give you a sincere thank you for what you do for us. It is truly appreciated, and I don't think as a society we comment on it enough, but we certainly do today. And just want to bring it in this live read, my brothers and Noah, because I know we've been talking about this separately just to share their thoughts on it.
I think sometimes we take for granted the freedoms we have, and the freedoms we do have was kind of built on some of the blood, sweat, and tears and people who paid the ultimate price for those freedoms. And I just think at times like this that we absolutely need to remember the people who fight for those freedoms and show our utmost respect and love and support in any way we can.
Yeah, here. 100%. I was in the airplane yesterday coming back from Philadelphia, where I had a trip out there teaching a 3-day basic training, and there was a young man at the baggage claim right next to me in his Army gear, and about my daughter's age. I could tell he was heading either to basic training or from basic training, and I just asked him, "How you doing, young man?" And he said, "Very good, sir." Very polite. Obviously, those Army kids always are. And every branch of the military has depth and all these people that really make America great, quite frankly. I mean, it really does. And I'm thinking about him a lot. I care about him quite a bit. We all do. Everybody supports the troops. There's no doubt about that. And it is quite a sacrifice they go through to serve and to put it on the line, because you don't know when you're going to get called, and you don't know when you're going to get called into a conflict zone or whatever it might be. And hopefully all this de-escalates, but definitely that's where my mind is here today as well. Matt, we're all here because we've got a very special unveiling. We do this at the very first of every single year. A lot of work has been put into the Tackle 25 2020 edition. This is one of our flagship products. It's something that we've put a lot of effort into over the years. It's grown, it's developed. There's a course behind it as well, and we're going to go through that list here tonight. First of all, how are you doing tonight, sir?
Tim, I'm very excited about the 2020 edition of the Tackle 25. I'm gonna kind of open it up and show people how we kind of developed that list and the process we go through, so that you guys can have an understanding and a trust behind that. Because and I've said this many times, but whenever you trade somebody else's systems, it's important to understand the rules. It's important to understand the techniques and the management and all that jazz. But I think you have to have trust, and to have trust in it, I think you have to understand how it's built, right? And so before we get into the unveiling of the new edition of the Tackle 25, I first want to recap the 2019 edition of the Tackle 25. And I know it was a historical year. I mean, best year in the market since 2013. S&P up 29%. And what really stands out to me about this year's list, Tim, and every year's list, is valuation matters to an investor. And in the last couple of years, I mean, growth has taken over, and it's the new sexy is growth, right? And give me that yield, give me that yield, give me that yield. And whenever you have a year like this year, and you're up 29% in the S&P 500, value has a tendency to underperform in that environment, Tim. And we put a lot of effort into making sure that these stocks on the Tackle 25 are fundamentally strong stocks with good valuations, EPS growth trends, everything about it. And despite the fact that this is more a value-based dividend cash flow type list, Tim, I just want to give you some numbers. And guys, I want you to think about this because we're all a team here. I want to just go through some numbers, and then I'm going to go through some of the individual stocks from last year. First and foremost, there were 25 stocks on the list last year, Tim. 24 showed a profit. When you're talking about that from a growth perspective, and you hit 24 out of 25, Tim, I don't care if the market's up 30%. That is really, really good, really good. Because a lot of that 29% is top heavy with the Apples and the Microsofts of the world, you know, those types of stocks. And, you know, the only stock that underperformed was Pfizer. It had a really nasty earnings report, if you'll remember, and it just got absolutely beat back down. Showed some consistency in the remaining part of the year. But Pfizer lost 10%. Everything else showed a positive out there. Like I said, 24 out of 25 with an average 28.11% return on investment. And for a list like that, I mean, to come into this year, if you were to tell me that, you know, the Tackle 25 would basically match the market minus 0.9% on just growth, not even taking into account the dividend, not taking into account the cash flow rate with the covered call, I would have said you were crazy. This list is not designed to perform that well. And it just did. And a lot of that is just market, right? The market had an absolute ridiculous euphoric last couple months in the market. And that kind of brought up a lot of these stocks. But despite that performance from last year, 14 stocks are getting kicked off. Mm-hmm. And not because of they lack the performance. You know, take a stock like Nucor, for example, right? Nucor didn't have a great year last year, really kind of went stagnant, only up about 8% versus the market at 29%. But Nucor is a really good still stock. It's a $60 billion still stock with good valuations. So why did it get removed? It just didn't meet certain parameters. We didn't get the infrastructure we thought we did. Coming into a political year, you know, that's a hypothetical scenario that may or may not pan out. I just didn't want to deal with the volatility of it, and we removed it. Take Intel. Nobody would say that Intel's a bad stock.
No,
nobody would.
It's a good company.
Nobody would. It's a good company. It's got good valuations. But it just, I mean, the ROI was just sucked out of it. Volatility was so low that, you know, it's not a great covered call stock right now. And that was the challenging thing coming into this list is, you know, whereas last year's list, all the cash flow rates were skyrocketing because of volatility of December of 2018. And this year, all the volatility subsided and taken out of the stock market. And so it was kind of hard. And, you know, Intel's just kind of one of those. You know, so the stocks that are being removed very quickly, NRG, a utility company, Nucor, a steel company, PayPal, a credit card servicing company, Intel already talked about, Delta Airlines being removed from the list, Garmin, a great performer for the last 9 months on the list after we removed CVS Corporation, and Garmin's going to be removed from the list. That's more from a valuation perspective. E-Trade Financial is being removed from the list because we don't know exactly what the brokers are going to be doing in the future, and we want to see how that the commission-free trading at the institutional level will pan out. So we just felt like that was a little bit of a risk. Also, ExxonMobil being removed from the list. And Exxon, that does not mean Exxon's a bad stock. These stocks can go sideways for a year and they're great cash flow environments, wonderful cash flow environments, and it pays a nice dividend. It just didn't, it wasn't getting the ROI necessary on the covered call. And so we removed it and put it onto Dividend Fireworks. So Exxon's still on Dividend Fireworks. Constellation Brands being removed from the list, valuation concerns. And quite frankly, coming into 2018, guys, I mean, 2019, I just felt like, you know, there was recessionary risk. And by the way, I still feel like there's recessionary risk, but I felt like very strong coming into 2019. And so I made a point of putting a cigarette company on there, a liquor company on there. And that's just not the environment we kind of saw play out. And that's certainly not the environment that we're seeing in the euphoria of the stock market in the last couple months. So Constellation, Altria Group, so Altria, the cigarette company. But it wasn't just cigarettes. It's the concern about Juul. It's the concern about, you know, the e-cigarettes and vaping products and whatnot. We think there's going to become regulations coming into that. So Constellation and Altria both being removed. Walmart being removed from the list. And again, a really good performer. Walmart up 27.58% last year, average cash flow about 1.5. It just, there were some really tough cuts. There were some really tough cuts, and Walmart was one of them. Starbucks being removed from the list, valuation concerns. Toll Brothers being removed from the list as well. And Toll Brothers, I mean, you want to talk about a difficult conversation between Pulte Group, Toll Brothers, D.H. Horton, and so on and so forth. They were all so just all really, really, really good stocks, all really good valuations, all performing very, very similar. D.H. Horton just decided to say, okay, you kicked me off in 2018, or excuse me, you kicked me off in 2019. I'm coming back for the 2020 because D.H. Horton is just doing absolutely amazing. So that's kind of, you know, kind of the stocks that were removed. The stocks that are maintaining multiple years on the list, and this means something to us when a stock stays on the list for multiple years.
Sure.
Newmont Mining. Okay, so let's talk about the stocks that are staying on the list. Here's Newmont Mining. It is our favorite gold stock, and there will never be a time where there's not a gold stock on the Tackle 25. And so when you're evaluating, and a lot of this is not only looking at the individual stock fundamentals, but it's really comparing these companies against like companies within the space, Tim. And so you're comparing Newmont against other gold stocks, other silver stocks, other mining operations. And Newmont just, you know, there were some discussions, but at the end of the day, it's like, why would we remove it? It's the best performer. It's got great valuation. And even though the price, I mean, Newmont went up 28.52% last year, even though that's the case, you still have a good PE ratio on that. And that's something that I want you guys to really kind of think about, because when you have a stock go up 20, 30, 40% in a year, and it still has good valuation, that means revenue and earnings are staying up with the price. That's a really positive sign, in my opinion, and Newmont's there. Obviously, Microsoft has been on this list since the inception of this list. And, you know, I don't know what would have to happen for me to remove Microsoft. Maybe Bill Gates gone, maybe. Right. But outside of that, Microsoft banner year, 55.2%, 55.26% performer. Apple, never removing, not happening. Great fundamentals, great valuations. It's going to maintain on the list, 86.16%. By the way, was not the best performer, Tim. You had and I was tracking this today because I'm always interested in worst performer, best performer. It was so close.
Oh,
it was,
wow.
I'm not kidding. Intraday, Tim. Intraday, it was close. And the winner was Applied Materials. Applied Materials on the list for the 4th consecutive year. Apple on the list for the 5th consecutive year. Applied Materials up 86.44% versus Apple at 86.16%. Both of them two are maintaining on the list. CSX Corporation. I love Buffett, and I'm a kid at heart, and I love railroads. I still, even though it underperforms some of the other stocks, only up 16% on the year. Really good cash flow still, and I still like the fundamentals of CSX. Boston Science, this little turner and burner, this is his 3rd year on the list now. Love this company. It's my favorite healthcare company. I didn't see anything in the data fundamentally to kind of change our opinion, even though it does have a little bit of valuation concern. It was such a good performer last year. I felt like even if we go sideways this year, good cash flow, good dividend there. So Boston Science, and I still believe they make robots, and I still believe that's one of the things that is going to be a growth area of the marketplace. Next one that maintains, J.P. Morgan. Jamie Dimon, he knows how to make money, and so does J.P. Morgan. Best bank in my opinion, and I know I just said best bank. Let me put it like this: they're the best of the worst. Okay, kind of like the dollar. The dollar is the best of the worst currencies, right? Mm-hmm. Well, JP Morgan, in my opinion, is the best bank out of all those banks there on Wall Street. Valero, I'm a little concerned about oil next year. I'm a little concerned. That's one of the reasons why I removed Exxon from the list as well. Valero, this has been multiple. Valero's, I think, been on the list 4 out of the last 5 years. Oil servicing companies, guys, one of the things that you got to understand when you trade oil-based stocks is drillers go in line with oil. Service companies do not. Services can do really well even when oil does bad. And I just kind of feel like the supply side of the equation in oil is going to kind of be dominant next year. I have oil projecting going down. I believe you did as well. I believe Noah did as well. In fact, in our prediction podcast, I think it was only Gino who really kind of thought oil was going to appreciate. And even at that, he was a little concerned about supply side mechanics as well. So, but when you're dealing with Valero, Valero is not that. Valero will beat to its own drum. Really good, fundamentally good company here on Valero. So they're maintaining on the list. CarMax, KMX. KMX, even though it had a negative earnings report just recently, but remember, we do not remove companies from the list just because of short-term volatility. This is a long-term investing stock list. This is not a swing trading list. This is in stocks go up and stocks go down. It has to be able to change fundamentally, or it has to be able to change with volatility or volume or one of the other criterias that we put into this list. But CarMax, even with the recent volatility, Tim, CarMax still up 39.76% on the year. The next two on the list, Activision, Tim, you know, we're going to have gaming stock on our list probably until we stop gaming, I would say. But Activision, when you take a look at EA Sports and when you take a look at Take-Two Entertainment, and Nintendo, you can't do what we do in the Tackle 25. So when you're analyzing Activision versus Take-Two Entertainment versus EA Sports, the fundamentals of Activision really stand out. The catalog really stands out. And I just believe this, and I could be wrong, but I just believe that the classic Warcraft, when they made that announcement and when they made that launch earlier this year, I think it's going to be a revenue stream for them, both with the retail version as well as with the classic version. So it's going to bring back a whole bunch of gamers who grew up playing that classic version in the early 2000s to the late 2000s, 2009, 2010. And I've already seen it across the board. Millions of subscribers paying $15 a month. Just think about that from a cash flow perspective. And not only that, but they launched Call of Duty on the mobile this year, which was a hit in China. They're getting into China. And so when you're looking at these gaming companies, and gaming's big business, and I think, you know, Candy Crush, Activision, Candy Crush, these gaming companies are figuring something out, Tim. Not everybody wants to spend $60 on a game, but they'll spend $1 here, $3 here, $5 there for some gypsy coins on Candy Crush, or this nice little gear on Call of Duty, or whatever the case might be on Warcraft, and it adds up over time. And what we're finding is that these gaming companies are actually making more money over time with what I call micro-dosing financial transactions.
My kids,
and
I got to tell you.
Well, yeah.
For Christmas, my kids, literally, they're 10 and they're 8, and your daughter's the same age, and they play some iTunes games. They asked all of their aunts and uncles and all that kind of stuff for iTunes gift cards. And
because all they're going to do is spend it on Roblox.
They just want to spend it on the games. Yeah,
it's going to be Roblox, and it's going to be $5 here, $10 there, and Activision. Yeah. I mean, they are doing a really good job of that in this space, and so I really like Activision. And then I don't know what Bob Iger and Disney would have to do. Apple would be gone before Disney. Microsoft would be gone before Disney. I just have so much belief in this company long term. Just long term. This is not a swing trading company. This is a get paid the dividend, cash flow, capture your 2% ROI, let it grow when it wants to grow and uncover it. But, you know, Disney's going to maintain on the list. So with that said, Tim, let's take a look at the Tackle 20. And before we get into the actual Tackle 25, I do want to show you guys the process that we go through. Okay.
You know, I think this is the interesting part, by the way, because as a part of it, you're the one leading all of this process. I mean, Matt, it's not like we start with 100 companies and go down to 25, right?
No,
I mean,
no. It initially starts with me running Scansy in Thinkorswim is what it does. And the initial list is put together based on me running, you know, just basic 3, 4, 5 different criterias, liquidity, volume, you know, some of the minimum standards that you need to be on the list, right? And so basically what that does is it therefore then breaks it down to basically about, I think it was about 1,200 stocks that I went through in putting together. So this was the first cut. And, you know, I'm looking at a lot of different numbers as I'm going through these line items. And obviously you see me marking some of them green, the ones that kind of stand out to me, and the ones that are going to make it to the next cut, and so on and so forth. And typically speaking, we'll have about 4 to 5 cuts, you know, as we go through this process. And so that's what it really kind of starts out at.
Stay there for a minute, because I got a couple of questions for you. And first of all, welcome out, everybody. It's great to have you guys on a New Year's Eve. Happy New Year. We're going through the Tackle 25 tonight with Coach Matt. And Matt, what's an automatic cut? What is something that would come up in the data that would say instantly that that's not qualified?
Implied volatility.
The IV. Yeah.
The IV
if it's too crazy, if it goes up and down too much.
Yeah. If the IV ranks above, like typically speaking, Tim, I'm looking for IV ranks in the 20 to 40 range. You know, I bumped it a little bit this year. just because volatility is so low right now. But that's typically what I'm looking at is in that range. And so IB rank will definitely remove out a lot of these stocks. Volume. You got to have volume. You got to have liquidity. Yeah,
That's why Nintendo, you were talking gaming. Yeah. Nintendo isn't qualified simply because it doesn't have the weekly options or the liquidity, right?
No, I like the company.
Yeah.
I like the company. It doesn't have to have weeklies, but it kind of does, right? I mean, we'll make an exception here or there if it doesn't have weeklies, but what company in 2020 doesn't have weeklies?
Also, should.
Let's get them. Let's get them.
The kind that don't make your list.
Yeah, exactly. So I'd say volume, implied volatility, liquidity in the options market. Price is not a killer, but if I'm looking at a $20 stock and I'm looking at a $200 stock and it's close, I'm going with the $20 stock. And sometimes that will mean that some of those high flyers that have the ability to go to, from 100 to 400 in a year, they're just not going to make this list because that's not what the purpose of this list is. And so that'd be one. Valuation, right? I mean, take Wheaton Precious Metals here. It's a company I actually like. It's probably the best company that just focuses on mining for silver. It's got an 822 PE ratio.
Can't do it. Yeah.
I mean,
41 peg.
There's so many different reasons why it would be there, and there's so many different reasons why it will move, and it just means that once the selling starts, it's like an avalanche.
Yeah.
Right. Because there's no dividend to support it. There's no valuation to support it. And when you're dealing with high yield growth type companies, it's just going to be a very difficult thing. I mean, one thing we've learned, and yes, we do learn from our mistakes as traders and as educators, but one thing we've learned from the Tackle 25 is we don't want, I love AMD. I love it. It's my favorite. It's my favorite semi, but it's got growth concerns. And AMD went up 150% this year. Man, that would have been awesome on the Tackle 25. Would have made the numbers really, really stand out. But I don't want that because AMD can be cut in half in 2 months.
Yeah.
Right. And so, and that kind of goes to volatility scale. And that's why AMD, AMD, let's face reality, Jim. We created Dirty Sexy Money simply to put AMD there.
And X, yeah.
And US still. And US still.
Right. And then it evolved over there.
You just wanted to remind me of that US still one is all you want to do there, buddy.
Well, there's a couple of things here I want to remind our class out there. Guys, there's value in what you're learning here. We went through a very, very intense process going from a big list, Matt, down to a shorter list into a cut. And that process is how you get there. Knowing that AMD can get cut in half in 2 months, that's your 15-year experience right there. Having that discretion to not put it on the 25, but put it on the Dirty Sexy Money list. I think that's an incredible part of this process.
The 25 is my baby.
Yeah.
It's I created the original one back in 2014, and I just love this list. It's been, if you compare this against any list out there, like the IBD, this list dominates it.
Oh yeah.
Dominates it.
Yeah.
And it's not growth and crazy, it's value and, PEs and all that. I do take a lot of pride in the list. I do take a lot of care in the list. But that first cut's not hard.
How many were on the first list?
About 1,200.
1,200. So, and then what we're looking at here is the version 2 after the first cut. Is that right?
Yeah. So basically when I'm going on that first list, Tim, is I'm literally just kind of going through it, and I am just streaming just the eyes left to right, just going through line item by line item. And if I see anything concerning, it's boom, gone.
Yeah.
High PEs, high PEG, EPS trends, those stuff. So, 90% is going to be cut just in the first cut is 90%. It's kind of like, Tim, if we went to try out for the NFL team, it wouldn't be hard for them to cut us.
We would not make the first cut.
We want to make
40,
the first cut.
At 40, I'm
No,
not
we
Tom
wouldn't.
Brady.
No,
So I would not. No.
Although if you want to have some high school stories, buddy, I do have some high school stories. You know, that one time in the playoffs when I had 4 catches, 157 yards. Woo.
Back in
I've got
the
a great-
two, I used to
It gets
throw this
bigger.
ball
It gets
out.
bigger over the years, by the way.
I've got a really great high school football story. One time there was this 16-year-old boy who had a dream of making the varsity team, and then his big brother laid him out over the middle in the very first practice.
Listen, this is nonsense, okay? This is nonsense. The only time at our high school that's ever happened, that year I was a senior, you were a sophomore, and they wouldn't let the sophomores practice with the varsity club, and I was so upset because I wanted to welcome you the Justice way. And then we made the playoffs, and the sophomores had to practice with us. We're running 7-on-7 drills. I was a safety. Tim was kind of running shadow wide receiver. He ran a little 7-yard cut pattern. I came in shoulder first, and I put him on the dirt.
I think you even told the backup quarterback, "Hey, throw it a little high." You know, throw Tim the
I didn't need that, buddy. I didn't need that. Okay, but coming down to the second cut, it does start to get a little harder because you've really got some good stocks here. And again, that second cut came down, I believe, it was like 150 or something. Yeah, 144 stocks.
Mm-hmm.
And, you know, there I'm looking at, okay, do we have enough service companies? Do we have enough tech companies? Do we have enough industrial companies? Do we have, you know, I'm really not only comparing the individual stock, I'm starting to compare the list against one another is what I'm really doing. So I'm looking at all these kind of material stocks. I'm saying, okay, here's First Majestic, here's Wheaton, here's this, okay, I'm starting to compare that against like-minded companies. And then after I cut that list down, that list then will come into this list. And basically at this point in the game, I start color coding everything. And this is where, Tim, you and I just sat there and, okay, we went through all of the ones that kind of made that second cut. Mm-hmm. And that second cut, we went through all the ones that made the first cut, and we just get, okay, this, if we're going to put it, here's 30 Seconds Money. Here's Poor Boy Covered Call. Here's a Tackle 25. And so we're identifying where the stocks, what stocks go on what list, and what stocks are getting axed based on that. The red means they didn't make the cut. You know, yellow, I believe that was Dirty Sexy Money. Green was Tackle 25. Blue was Dividend Fireworks, and orange, orange was Poor Boy Covered Call. So that would be the second cut, is when we're identifying, okay, the stocks that made the first cut, what list could they go on, and what stocks just don't have the fundamentals necessary to do what we need to do. And then the next list here, the fourth version, the fourth version here is where we really start to kind of break it down. And this is where Gino, myself, Noah, and Tim got together. And guys, this was a marathon that day. I mean, just an absolute marathon. And we're going through each one of these stocks, and we're eliminating which ones we're eliminating. And it brings us down to 33 stocks on the Tackle 25. It brings us to, I believe we had 26 stocks on Poor Boys. We had 21 on Dividend, and we had 15 on the DSM list. And this is where the real cuts happen, right? This is where it starts to get difficult, because you're cutting stocks you like, one way or the other, whether you invest in them, but you might like them, right? Mm-hmm. And so you're cutting stocks you like. And so we start with the Tackle 25, and we start breaking these down and say, okay, let's vote. Let's vote. And that's where it comes into, and Gino, myself, Tim, and Noah will vote. We'll have discussions. Gino will break down how he sees it. Noah will break down how he sees it. Basically in that meeting, I was just kind of sitting back going, you guys you did the analysis. I already know. Mm-hmm. Right. Mm-hmm. And so I was just kind of leaning back, just listening to you guys like that. And finally, after all of that, Tim.
Stay there. No, stay there. There's a couple things I want to look at here, and kind of point out a couple of things of value for people who are out there, might be new to the Tackle 25, try to figure out how to use it. Go to the DSM tab down there real quick. Something grabbed my eye here that I thought was incredible. Look at the market cap, Matt. People might hear DSM, they might be thinking these might be small companies and all that kind of stuff. These are still 40 billion, 50 billion, 7 billion, $11 billion companies. I mean, these are still established mid-cap, large-cap companies with liquid options that are tradable. Yeah.
Yeah, they're mid to large. And I mean, you really got to hunt. I mean, you got to get the bird dogs out there and you got to hunt for these, because there's a million of these types of stocks. I mean, just an absolute million of them. And, you know, I mean, there was some easy cuts, you know, on this list, and there were some difficult cuts on this list. But yeah, I mean, once it comes down to that last tiebreakers type scenarios, you know, we're splitting hairs, you know, and some stocks that are really, really good stocks didn't make the list.
Well, when you go from 1,200 to 55 final stocks, there's going to have to be some really tough cuts.
That is going to happen.
Yeah.
And here is the list, ladies and gentlemen. And yes, we will be sending this out to everybody, I believe tomorrow. Tomorrow, yeah. Right? In an email, maybe on Thursday. The new ones that made the list. I mean, obviously, we've already talked about Newmont. Phillips 66, you know, like I said, I just have a feeling. I got a feeling about oil, and I could be wrong. But even if oil goes up, Phillips 66 and Valero can be good. If oil goes down, they're typically good. So I just like the probability analysis on one of these. I want to do them both, right? I mean, if you're picking 10 stocks to do covered calls on long-term investments, you certainly don't want two in the same space. But both of these two companies, it just absolutely fantastic companies. The one I like the most is Valero out of the two, but I wouldn't fault anybody for Phillips 66. I mean, it is actually a bigger market cap company than Valero is. Both have really good valuations here, right at 11, right at 14. PEG ratios are good. Both pay a slight dividend, but not much. Newcomer to the list, and a little surprising. Lulu made the list, and when I'm looking at the consumer good space, Tim, and when I'm looking at this as a macro 64,000 feet in the air, there's only two companies that stand out to me. There's only two companies that stand out in the sense that they're going to be here and they're going to be here forever, and that's Lulu and Apple. And I believe it was Noah. I mean, Noah, was it you that went to before Christmas? You went to
I took my
mall, right?
annual trip to the mall. I go every year at the holidays, like sometime around Christmas Eve, and you got to get that shopping in. The only two stores that were, I mean, literally it was jam packed. Like it was like, I mean, you had to like lift your arms up to move between people. Like it was crowded. The Apple store.
Apple and Lulu
and Lululemon. And my daughter, who's got a little bit of, you know, agoraphobia when she gets out in the crowds. Like she didn't even want to go into either store. And that's the only reason she came to the mall with me, is because she wanted to go into the Apple store to get some new AirPods. And she wanted to go into Lululemon because she had a gift card to get some pants. And I'll tell you what, jam packed like sardines. It was insane. Every place else though,
Ghost town.
It's like the mall in and of itself is kind of a ghost town. Like if you have to leave the house to get stuff in 2020, you did something wrong.
But there's several parts of that story, though, that are anecdotal in nature, but obviously very valuable. Number one, brand recognition, customer loyalty. You know, in both of these brands, people who love the brand, people who love Apple, they buy Apple all the time. I do.
Tim,
my family does.
What
my
Noah's
wife
defining is what everybody did in the 80s. And I mean, this is when Benjamin Graham's version of value investing first kind of modified and changed, was in the mid 1980s with Peter Lynch. And basically what was happening is, you know, Buffett and Benjamin Graham would say, okay, yeah, you can invest in things you know and companies you like, but you have cognitive bias, right? And so it was almost like a warning to don't invest in companies you work for, because it's hard to, it's like you have beer goggles on constantly, right? And then Peter Lynch comes in the 1980s like, hey, listen, go to the shopping malls, go to the strip malls, see who's going to those stores. If you see a store that's packed and you see a store that's not, well, I'm willing to bet the revenues of Lulu and Apple are going up. And that's exactly what's happening here with Lulu. And even though Lulu, specifically Lulu, it's got a little bit of a high valuation right now, a lot of that is because it's up 100% year to date, right? So at 54 valuation, that is slightly higher than what is typically allowed to kind of have on the Tackle 25. But when you break down the fundamentals of this company, Tim, I just love this company. I see this company, and it's a profitable company. It's a darling of the market. You know, obviously we're stagnating in Lulu right now, but EPS projections in the last 5 all positive. EPS projections in the next 5 all positive. I mean, this is a company that has the ability to truly dominate the clothing apparel, the high-end clothing apparel type space. And I just think, I honestly thought it was going to be a year too soon with Lulu, but it turned out to make the final cut. It's a company we really like.
Stay there for a second, because I think there's a great question. Hopefully it's a great question. What role does charting play? Because if somebody's just looking at this, they're like, that's beautiful, obviously. You know the fundamentals behind it, how much of a role that actually plays. But somebody might be out there thinking, well, that's a beautiful chart. Is that the reason it's on the list? Does charting play a role? What role does it play? All that kind of stuff.
It plays a role.
Mm-hmm.
I mean, we're not going to add a stock that's just getting absolutely just slammed, right? But and to certain coaches, it might play more of a role than it does to me. I use technical analysis as a tiebreaker type scenarios. So if I'm looking at two stocks of equal fundamental nature, then yeah, I will absolutely say, okay, the stronger trend, the more consistent trend is what we want. When I'm looking for trend analysis and technical analysis in general for stocks that go on the 25 TAM, I'm looking at consistency in patterns, consistency in trends. I'm looking for something that isn't random and volatile and can shake you out. I'm looking for stocks that, you can trust. You can trust on the technicals, but it's tiebreaker, it's consistency in patterns and trends. I don't want to see too much volatility, those types of scenarios. And it kind of goes back to the growth versus value discussion. You're going to have more volatility in growth companies. And, Lulu is a growth company. It's not a value company yet, but there's a mix there, obviously on the 25. There's some growth and there's some value there. But I just believe this company will be a value-based company at some point in the future. The forward P ratio, which I don't give too much credence to, is projected lower than the actual PE ratio right now. If Lulu's price stagnates and the revenue catches up, that PE ratio is going to come down really, really quickly. Yeah. So I'm not that concerned about valuation on a company like a Lulu. Bank of New York, the Bank of New York Mellon Corporation. Not surprising, it made the list. It's been evaluated, it's gone through multiple cuts in previous years. But I'll tell you, with this company, I wanted to kill it. I did, because everybody knows how. I don't want to say emotional, but I do have bias towards the banks, right? I do have some anti-bias towards the banks. And so I looked for a reason to kill it. I did. I just wanted to. And I was just like, whoa, I can't put another bank or JP Morgan. Now, this isn't a bank. It's an asset management company. Okay, so they're not in the same space as JP Morgan, which is a big money center bank. But Tim, when I'm looking at this and I see it, $14, $2, $2.71, $3.15, $3.04, $3.94, very consistent in EPS growth. Book value is really good. Return on equity is really good. PE ratio at 13, and a chart that's doing that over the course of the last 6 months. Pretty decent valuation there. I mean, but the kicker, so there's a little bit of a tiebreaker within the banks, but we could get pretty decent 2% type cash flow out of this, and it's pretty liquid. So Bank of New York Mellon Corporation, welcome to the first time on the Tackle 25. Same thing with Phillips 66, by the way, first timer for Phillips 66 as well. Discover's been on the list, I believe. Maybe we usually have a credit card company on the list. Last year it was PayPal. This year we put Discover and American Express. And guys, I mean, let's just face reality. Where the Fed fund rate is right now at 1.5%, the average credit card interest rate, 15%.
Yeah.
Think about those numbers for a second.
Yeah.
And most spending in America right now is not done based on savings and not done based on, paycheck to paycheck. That's usually going to pay bills. Paycheck to pay. Most people in America are paycheck to paycheck. So how do they afford those luxury things? How do they afford to go on vacation? They go into credit card debt with an average interest rate of 15% with a Fed fund rate of 1.5%. You do the math. American Express, Discover, they're in an environment to dominate. All those credit card companies are. These two stood out to us.
And there wasn't a lot going on in the market today, but the one economic data point was a consumer confidence number that came in at 126. Yeah. The consumer has been very, very confident. They're using their money. Credit card companies have been easy calls for a couple of years now. DFS is one I really, really like the fundamentals on. Love the PE ratio, love the PEG ratio. It's a value company, and it's not a determining factor. But the 2% dividend, it is nice. It's nice to add to the other fundamental factors that make it a candidate here.
Oh, Tim,
Welcome to the 25.
Ratio at 10. I mean, a PE ratio at 10, a PEG ratio at 0.93.
Yeah.
And a dividend at 2.49.
Yeah.
Yeah. What are we talking about?
Welcome to the list.
Yeah, welcome.
That's what we're talking about.
I mean, find something wrong with Discover. I can't.
Yeah.
American Express, it's just a juggernaut. It's just a juggernaut.
Yeah.
Welcome to the list, American Express. JP Morgan, we already talked about Boston. Let's talk about the construction companies really quickly. There was a report that came out earlier this month that the construction companies, D.H. Horton, Toll Brothers, Pulte, who am I missing? KB Homes.
Toll?
Or
Toll.
Lennar. And Lennar. When you're looking at those companies, they have the highest confidence that they've had in the last 20 years. And although I disagree with the Fed on monetary policy and think they're running a risk to inflation and think it could be really nasty in 15 years from now, people are going to borrow a ton of money and they're going to buy new homes.
Yeah.
And you got an entire generation, that millennial generation that's in that, now 22 to 40 bracket, right? You got that entire generation now in the middle of their, I might want to get married. I might want to have kids. I want to have the American dream. I'm going to build going to have a 2-car garage, white picket fence, going to have 2.2 kids and just have a fantastic life. And I want to have a home, right? Want to have a home because I don't want to go pay record levels of rent. Why would anybody rent today when they can borrow $500,000 at a 3% interest rate? And when you think about it like an investor like that, and you see the consumer confidence numbers where they are, and you see the unemployment number where it is, and people are pretty, complacent and happy economically, man, I could see the home builders being really, really confident. I'll tell you, it was difficult. It was difficult. And the one that got removed from the list, Toll Brothers, it was not even the last two of the home builders. It was Pulte and D.H. Horton. I mean, it was tough to remove Toll because Toll's one of my favorites, but D.H. Horton's fundamentals, a 13 PE ratio, a 0.85 PEG, 1.25% on the dividend. Looking at D.H. Horton here from a charting perspective, a company that literally last year on the list, it was up 89%. This year, it's up like another 70%. And oh my God, it still has a PEG at 98. It still has a PE ratio of 13. Do the math. Earnings are growing here and people are going to be buying more homes. They tear them down, they rebuild, right? So I just, it's stagnant right now. Good opportunity, obviously a little bearish in the short term. Maybe you wait for a positive earnings report here. But D.H. Horton, the fundamentals behind this company really kind of stand out. As you can see, every single year, increasing earnings per share, increasing book value, good return on equity, and you got wonderful, wonderful valuations. Despite the stock going up over the last 5 years, still undervalued in comparison to the average of the last 5. D.H. Horton, welcome back to the list.
Well, and right there's a point that has to be made on that because, guys, a low PE ratio is not enough. If you have a low PE ratio on a stock with bad fundamentals in a downtrend, it's usually not a good signal. So we're not just looking at the number and saying, okay, that's a 10 PE, here we go.
Well,
we're putting the totality of the evidence in.
A lot of times those stocks that have high valuations as the stock's going down, it's because they're losing revenue.
Yeah.
Right? It's losing revenue. And sometimes even when they're maintaining revenue and the valuation comes down, that's one thing. But I mean, it's just so impressive to me for a stock to go up as much as D.H. Horton has done and still have proper valuation, right? Not get into that 60, 70 type area where you just start to get concerned. You just start to get concerned. Lulu's more growth. CarMax isn't. And so valuation matters. CarMax, welcome. Target, we all love Target. Target's been on the list. How many years? 4?
Well, at least that, yeah. I mean, it's a way.
I'm going to go check this, but there's only like 3 or 4 stocks that have been on the list the entire time.
Apple.
Disney's not one of them.
No.
Disney got removed because of you couldn't get cash flow on it one year. I think it was like 18 or something like that. Apple, Microsoft.
Maybe Target.
It might be Target. It might be Target.
Yeah.
Outside of that, yeah, it might be Target. Because I Applied Materials, that's only been 3 years, but yeah, Target's a wonderful company. Really, really like it. Little high on valuation right now, but not too bad. Best Buy made the list. It's been multiple years on the list. Best Buy, one of the big box retailers that actually started to get it right online. And online spending and whatnot, they're starting to do a little bit better. Signed some deals with Amazon as well. Good valuation on the PE ratio. Pays a 2.3%, 2.39% dividend. You can get about 2.5% on the cash flow right now. So Best Buy, definitely welcome back to the list. Disney, everybody knows my opinion of Disney, guys. I just feel like they're taking over the world. Everything Bob Iger does turns to gold. Everything he does. When we were giving the prediction podcast, and the question was, is it going to be Disney or is it going to be some other company that produces the highest grossing film in 2020? You guys all went with somebody else. And what did I say? Y'all crazy.
Yeah.
I don't care. You don't know what they have coming down the pike. They can throw out some animated Pixar stuff and everybody's going to go to it.
It's true. That's the wild card. Yeah.
2 words for you. Baby Yoda.
Well, they don't have a movie
what
around.
They're going to do with old Baby Yoda.
They don't have a movie around Baby Yoda yet. But when it comes out,
But
they're going to make
merchandise
10 billion.
potentials alone, unreal.
Yeah.
But the one thing I'll say about Disney is every decision Bob Iger has made for that company has turned out. The acquisition of Hulu, Disney Plus, the Pixar, the Star Wars, the Marvel acquisitions, everything that company has done besides ESPN. That's the one drawback. Traditional media has been really, really struggling over the last few years and will struggle over the next few years. But I just love what Disney's doing in terms of positioning themselves to get into that Netflix space. And after 2 months now, I mean, we're talking tens of millions of subscribers, and that's just going to get bigger and bigger and bigger. Restoration Hardware was a shocking one for me. A shocking add-on for me. I never thought, because I know this company only because my wife likes their products. Right? I mean, they're a high-end variety home furnishing company. And they do have wonderful products. It kind of reminds me of that Yeti. Like, people will pay a little bit higher price for Yeti because not only the quality, they just love it. Right?
I can tell you, Matt, I once decorated my whole house based off of Restoration Hardware stuff.
That does not surprise me in any
capacity. It looked
fantastic. I'm not
fantastic.
going to
It looked
fantastic.
Well, it was, in all transparency, one of the last stocks to make this list, Matt, because there was some hard calls on this one because it's a newer company. You're talking specialty retail, and it does have some volatility. But the fundamentals were just so outstanding. It just could not be denied. I mean, it just kept coming back up and back up and back up and back up. And its growth projections
I kept saying no.
Yeah.
Like, I kept saying no. I was like, I can't get there. I can't get there. I don't trust it.
Yeah.
But when you look at especially the last 3 years, Tim, especially the last 3 years, EPS numbers going from 13 cents to 31 cents to 568 to 774. Man, if Tesla could actually do that, I actually might support Elon Musk. I mean,
well, they are selling cars in China now. They got a new production unit and all that. Yeah. I love it. Golf clap on.
We'll get a little violin for you, Elon. But their numbers are very, very impressive. But Tim, again, I come back to this. You look at a stock that in the last 7-8 months has went from $100 stock to $213, 113% price appreciation. And look at this, Tim, 5-year average of the P ratio 39, and now we're rocking 28. So despite going up 113%, guess what went up even more than that? Revenue.
Yeah.
Revenue. Revenue matters, value matters, earnings matter, all of that. And even though I didn't get there at first, it took me a couple weeks to get there, but I did because the fundamentals stood out. And I just, when I was breaking it down there was about 8 companies that made that last cut that we had to cut. It was the best of the bunch. And I felt like we had enough dividend. I felt like we had enough value. And I felt maybe we were short on a little bit more aggressive type company. Even though Apple went up 80% this year, I would not consider that to be an aggressive company.
No,
I mean, they're a $1.3 trillion company.
Well, hell, they have over $200 billion in cash. I mean, that company is just stocked.
Oh man. Next stock on the list, CSX, we talked about Dick's Sporting Goods. Yeah, Dick's Sporting Goods, another little surprise. but kind of like Best Buy, Dick's has done a wonderful job, just an absolute wonderful job. And growth, a little bit more of a growth-based company. Let me see if I can get you exactly what the numbers are here. So just give me a second. P ratio at 13, forward P ratio at 12, peg right there at about 1.5. Little surprising, Tim, it pays a 2.2% dividend.
Mm-hmm.
And the numbers are very consistent. And the P ratio is very good.
This is one of those big box retailers who's also done really well online. I mean, if you go shop for some of this stuff online, Dick's is going to be right there. Boom, 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 boom. Their numbers are great. And the cash flow here is pretty good too.
Well, and I also like a couple things. You're getting around 2.2% cash flow on it. That's really, really good, especially in this environment, guys.
Mm-hmm.
Once volatility comes back, and it will, okay, the 2.2%, this will be a 3.5%, right? And so when we're looking at Dick's, you're getting 2.2% on the covered call. You got a really good valuation. Price has been going up, but I love it in that price range, $50 stock. You know, I don't love doing covered calls on stocks that are $200 like you know, Apple is. I'd rather play it a different way, right?
Mm-hmm.
But in terms of Dick's, I mean, $50 stock, really kind of priced to perfection here. Yeah, you know, just one thought off the top of my head. You want to stop the next recession? No. Let me put it like this. Yeah. No, I'll say that. You want to stop the next recession? You don't need to pump in billions of dollars of liquidity into the market, Fed. You know what you need to do? You need to have Apple split 4-1.
Mm.
You need to have Google split 10-1. You need to have Amazon split 12-1. Mm-hmm. You need to have all these high-end companies that have made so much money over the last few years. You need to just have them split.
Mm-hmm.
Put them on a discount.
Yeah.
People won't even understand it.
Yeah.
They'll be like, oh my God, I can go buy Apple now at, you know,
$20. Yeah.
$20,
$50. Yeah. Whatever the split would be. Yeah.
Just have the entire market split. Just make
I remember when Apple split 7-1, it created demand instantly for the company, especially when they're fundamentally strong like that. It would be a really, really interesting.
Apple was genius about it because they started doing this whole marketing campaign about, $92 a share. You can buy a share of Apple before, it's just, there's things that they do to trigger emotional responses within the consumer base.
Yeah.
The reason they split 7-1 is to get it under $100 so that they could see demand come in at that double digit instead of the triple digit. Mm-hmm. It's the same reason why Baidu many years ago split 10-1, right? I mean, just to get it at it, they wanted it underneath that single digit, and then all of a sudden Baidu went back up to $100. Splits are bullish. Splits are bullish. That's all you need to do now. All right, Dick's, wonderful company. Welcome to the Tackle 25. Facebook. Now, I'm going to let you talk about Facebook because I hate this company, and my bias will absolutely come through. But the reason I hate them is probably the reason why we put them on the list.
It's simple, by the way. I hate the company too. I would love to not have them on the list. They're just too damn good of a fundamental company. And you've got a 2020 factor here. Noah made a really, really strong point. Guys, we got politics next year that are going to drive ad spending and all that kind of stuff. I mean, you got a presidential election. The numbers are just too good, man. That's all it comes down to. At the end of the day, there's no emotion in investing. It doesn't matter whether we love or hate Facebook or use Facebook. Facebook as a company for a covered call at $570 billion, they're just a good position to do covered calls.
And the reason I hate Facebook has nothing to do with politics, to be honest with you. No. You know, if people are going to be influenced because of a 30-second nonsensical ad on Facebook, then they got more problems in their life than I can deal with here. So that doesn't bother me at all, but it's privacy. I'm a privacy guy. I'm a privacy hawk. And when you basically sell our third-party data, our private data, the third-party apps, I'm out. And I felt like there was going to be more backlash to that. And there wasn't. We didn't see it in the numbers. Usage went up. Subs went up. Everything went up. Advertising revenue went up. And, you know, I believe it was Noah, I believe, or no, Tim, in 2020, when we were talking in the prediction podcast about what sector you felt was going to be the best, communications.
It was three of us. It was me, Tim, and Gino. We thought it was tech and communications.
Well, I had it too. I had Tech 1 and Communications 2 is what I had. And I think you had Tech 1 and Communications 2, and Gino had Communications 2. And then Tim was like, I love it all. Everybody loves tech. But, man, so many good names in communications, and Facebook's one of them. And it's like, what, 20%? Is it 20 or 22% of the index?
Oh, no, they're like 19. I think Google was number one, then Facebook. They're right up there too. And by the way, another company who's a top 10 holding in the communications sector is the next one on the list. It's Activision. Gaming is there as well. It was one of the other reasons why I loved communications. I just see that we're all using. I mean, we're on Zoom right now. We're communicating via these devices, via this medium. It's not going to go away, and Facebook is not going away. There's no question.
Well, and I just, I mean, there is regulatory risk with Facebook.
Yeah.
But I do not see that regulatory risk coming in 2020.
Maybe down the road.
Yeah. And there's Libra risk with Facebook as well. But I don't think the market is priced in a positive Libra response. So if there's a negative Libra response, I don't think that's going to have an impact.
Mm-hmm. Mm-hmm.
Well,
Right.
you mentioned earlier, Matt, about having a cigarette company or a tobacco company on there. I can't tell you
Facebook's
how
a nice
much.
company.
Oh, Facebook, it is the new tobacco.
Yeah.
It's addictive. It keeps people plugged in all the time.
You stole Mark Benioff's line. He literally said that in a speech the other day. It's the new.
I'm pretty sure I read that, and I'm pretty sure that I ripped it straight off. I can neither confirm nor deny, but he's not lying. So I mean, it's like
No,
Tim's only calling somebody out because he loves Mark Benioff.
I do. That was Mark Benioff's line. I retweeted that.
I'm sure. Well, I've thought about it for years, and it's true. It's one of those things. It's just like media is the new
parallel thinking.
Yeah,
you and Mark Benioff. I got you.
Nope. I actually read it straight up, so I will go ahead and we'll call that. What do they call that? They call it cryptonesia. Cryptonesia is when you feel like you saying something originally, but you totally picked it up someplace else.
You do it all the time.
It's like all my jokes. I mean, really. So yeah.
Yeah. Facebook, Activision, two of the tech names, obviously, that we're talking about here on the Tackle 25. Matt, there's four more to round these out. Jabil, Xilinx, Applied Materials, and Onoke. Kind of talk about these four as well, if you can.
Yeah. Jabil, obviously we're going to be tech and service heavy, right? Because let's face it, most stocks in our market are tech and service, right? And so when you're looking at JBL, printed circuit boards and so on and so forth, it's got good valuation of 31, forward P ratio at 10, pays a slight dividend right there at 0.77%. EPS numbers this year, 32%. EPS numbers over the next 5 years average at 12%. Fundamentally pretty strong stock in a space that, is going to be and this is just my opinion, but I think the entire information, circuit boards, any type of semiconductor, any type of cell phone provider, internet provider, I think is going to be an amazing ride over the next 5 to 10 years because of the transition from 4G to 5G is happening.
Mm-hmm.
And that's a really, really big deal, especially as we start getting into more smart cars and the speed of information and cryptocurrencies and you get into and you name it. So obviously we're going to be heavy here in this space with JBL, but a wonderful, wonderful company. A little bit of a surprise. Thought it would be a little bit more dirty, sexy money, but it had the fundamentals. P ratio of 23, PEG at 1.93, pays a 0.8% dividend. A little bit of a smaller company, $6 billion company here, but keep an eye on this company, JBL. Let's take a look at JBL very quickly from a technical perspective. Looking at this from a technical perspective, very consistent in the trend. I actually kind of like this from a swing trade, to be honest with you.
Yeah.
Trigger above 42, stop loss right there underneath 41. That's pretty good, decent little swing trade right there. But very consistent in trend, priced at $41 for covered calls. I mean, people love that $20, $30, $40 type stock for covered calls. Volatility right there at 22%. Again, I do believe all those numbers are going to be going up, but you can get about 2% on that covered call right now. Very safe little company. Next on the list, we got Xilinx. Xilinx, another semiconductor company. And I'm going to tell you, Tim, we broke down about 10 semis.
Mm-hmm.
Applied Materials is 1A, 1B, 1C, 1D,
Mm-hmm.
right? I can't believe Mark was surprised when you said Applied Materials. Has he never listened to me talk about Applied Materials?
I'm not sure how much he listens to anything.
Anybody?
Besides his dates lately. I mean, he is single task focused right now. There's no doubt about it.
He really is, isn't he?
Yeah.
But both these two companies, they're semiconductor companies, but Xilinx is more integrated circuits. Okay. This one's more equipment and whatnot. Both these companies are really, really good companies, fundamental, strong companies. PEG ratios and valuations are getting a little concerning just because price has been going up so fast here. So keep an eye on both these companies. And then we have to have a utility company. Have to. It's a must. I cannot not put a utility company on there or it breaks rules, right? Diversification type rules. And Oki is the best one out there. It just is by far. There were other companies like Southern, which were really, really, really good. Fortino, that gets a yellow card, buddy. And the only reason it doesn't get red cards because it was funny.
Yeah, it's pretty funny actually.
Yeah, no, that is no PCG. And Fortino hates PCG, by the way.
You know, by the way, that's our Tackle 25. We're going to go through the other list here in just a minute. But in the chat right now, first of all, it's great to have you guys here on New Year's Eve. Like I've been saying all night, Happy New Year. Just type in Tackle 25 in the chat. Let me know that you're out there. And a couple things, Matt. We did have a question come in the Q&A section. Noah reposted here. I think it's a very good question for right now because we're going to be talking about the other list. And it says, it's from Mark, and it says, why are there different lists on the Tackle 25? Referring to the Tackle 25, Dividend Fireworks, Poor Boys Cover Calls, and the Dirty Sexy Money. What do you think?
Well, the Tackle 25 is our list. I mean, that's the list. There's no other list. But what we'd found over time is that there was a demand for other type of list. And what we found last year was there was a couple stocks that we removed from the list because they just got too high priced, right? And we just we can't remove that from the list. We got to find somewhere else to put it, right? So we're like, okay, high dollar stocks that meet the criterias of the Tackle 25, we put them on the Poor Boy Cover Call list. So instead of focusing on covered calls, we do diagonal spreads, horizontal spreads. A lot of people do credit spreads too, right? So vertical credit spreads. So there is some subtle differences between the Tackle 25, Dividend Fireworks, and Poor Boy Covered Call, but they're the same fundamental criteria.
Well,
right?
and you kept saying, and by the way, just to make that point even further, during our analysis, when we were breaking it down, refining it, you kept reminding the team, guys, it's got to be qualified for both lists. If it's not qualified to be on the 25, it can't be on the Poor Boy Cover Call, period. You know, it has to be qualified with the same fundamental criteria.
Well, you're approaching it with the same scenarios, right? Instead of buying the stock, you're buying an underlying call option, a long-term option. You're writing that same call option against it to create that diagonal spread. So, you know, you're just, all you're doing is substituting the long-term option, which you're planning on holding for the next year, and selling that short-term option. It's very, very similar. So for me, it was very important to make sure that whether it was Dividend Fireworks or whether it was Poor Boy Cover Call or whether it was Tackle 25, I mean, you had to have the same fundamental nature. So, I mean, the Tackle 25 is the list. I mean, that is our primary list. And the other list we created just to kind of fit different mindsets, different demographics, different portfolio designs, and so on and so forth. So when you're looking at Poor Boy Covered Call here, one thing you'll notice about the Poor Boy Covered Call list is most of these stocks are extremely, not extremely, but they're a little more high end, right? The valuations can be a little bit higher because they are a little bit higher priced, but you know, you're looking at Nike, Anthem, Visa, Lockheed Martin, Costco, McDonald's, Tractor Supply, Salesforce, NVIDIA, and BABA. And with Salesforce specifically, it did have too high of a valuation for us to put it on the list. But when you actually look into some of the numbers there, you can kind of understand why it has a short-term high valuation. I think that will change. And Salesforce is just a company we believe in based on a guy that we both have an absolute love for in Mark Benioff. So the difference in this list versus the 25 is these might have a little bit higher valuation than the 25. They might, dividend really doesn't matter because we're not buying the stock here, but you're just talking about a higher dollar stock, right? Still fundamentally strong companies, still the brands you love, but just a little higher dollar stock. When you're looking at Dividend Fireworks here, you know, this list is fundamentally very similar to the 25, I would say. Very, very similar. Whereas I'll kind of get into the gray area on valuation on Poor Boy Covered Call. I'm not on Dividend Fireworks. The differences between Dividend Fireworks and the Tackle 25 are subtle but important. Number one, you cannot get on this list unless you pay at least a 2% dividend. That's number one. We'll have growth stocks on the list, guys, on the Tackle 25. So when you're looking at the Tackle 25 and you're seeing, well, Matt, right, there's no, Lulu doesn't pay a dividend. Boston doesn't pay a dividend right now. Boston, get your act together, pay a dividend. CarMax doesn't. Restoration Hardware doesn't, because typically those are more growth-based. But when you're looking at the Dividend Fireworks list here, Tim, look at your dividends across the board, 3%. That's 3%. 3%, 2%, 3%, 2.5, 4.7, 4.4, 4, 5.3, 4.09. And so, yeah, just because a company pays a 5% dividend does not mean it's a good buy, right? You really got, because sometimes, you know, stocks will beg for buyers by increasing dividend. But these companies are really, really fundamentally strong companies. They all have really, really, really good valuations. All of them are under their sector valuation. You know, PEG ratio is a little out of whack right now, but PE ratios are perfectly in line. Dividends are fine. And you got ExxonMobil, you got Coca-Cola, Bank of America, all three of those stocks, Pfizer, all four of those stocks, Home Depot, all five of those stocks, Las Vegas Sands, all these stocks have been at what point on the Tackle 25, other than Southern, Seagate, and I believe Las Vegas Sands.
Yeah,
I think those are the three companies that have not been on there. But Las Vegas Sands, oh man, fundamentally really strong stock, and it pays a 4.49% dividend. And we wanted to get one of those gaming companies, the casino companies on one of the lists. And, you know, we looked at Las Vegas Sands, we looked at the Wynn Resorts, we looked at MGM. Those are the three companies that we really kind of broke down. MGM had valuation concerns, fairly big, good cash flow, but valuation concerns. Las Vegas Sands is out of those three, in my opinion, the most fundamentally strong stock, right? And when it pays a 4.49% dividend, I mean, or 4.71, I mean, just sign me up already. P ratio at 19%. So with the Dividend Fireworks, the cash flow rate is going to be a slightly lower than what you'll get on the 25. Okay, so you might get an average of 2% right now on the 25. Again, once volatility picks up, it's 2.5 to 3%. But with Dividend Fireworks, you're right now 1.2 to 1.5% on the cash flow rate. That's what you're getting by selling the call option to bring in it. So when you hear us say something like CFE, or the cash flow rate, cash flow expectation, cash flow rate, that's just based on, okay, if I buy a stock for $10 and I receive 50 cents on the call option, that's going to be $50 versus a $1,000 investment. That's going to be a 5% return on investment. So your cash flow expectation would be 5%. So when you're looking at the 25, you're looking right now between 2 and 3% on the cash flow rate. When you're looking at the Dividend Fireworks, because of the dividend, these are all value stocks, is what these are. Every single one of these are value stocks. You're going to get 1.2 to 1.5 and 1.5 to 2.2 in a more volatile environment. But you get paid that really, really nice, hefty, nice little dividend. And these stocks don't have a tendency to move as fast as, say, Poor Boy or the Tackle 25. So you don't have a lot of management. It's kind of boring watching paint dry on a wall type scenarios. And you know what? We want that. We want the sexy in a portfolio, but we want more boring in a portfolio.
A lot of times we want boring. I was just going to say that. I mean, you know, the reality is when we're sitting there talking about it, we had you and me and Matt and Mark and Noah and Gino, we were finalizing the list. I think Mark got most excited about this list, you know, because that's the style of investing he does.
That's his style.
Yeah.
But I will tell you, once we finalize Dirty Sexy Money, he's like, oh my God, that is.
both. Because the other one is great for the boomerang stuff. I mean, that DSM list, there's a lot of ways you can use this.
There's so many different ways you can use this list. Naked puts to covered calls in the boomerang, covered calls, credits. There's a lot of ways you can approach this list. This list is a little, it's unique. It's unique because these stocks are not fundamentally strong stocks. They're just not. Either one, they're negative PE ratios, they're debt-driven companies, but a lot of times companies are debt-driven for years before they find that path to profitability. And I agree with Elaine on the Dividend Fireworks. Great for retirement accounts. Great for retirement accounts. I would say these are companies that, number one, are growth-based. Okay, so they have higher upside and higher downside from a growth perspective. Number two, they have high IV ranks, right? So typically a stock on this list will be, typically above 40 on the IV rank. I think right now it's above 30 just because I had to adjust for volatility where we're at with volatility, right? I mean, you can't force your will on the market. You have to adjust to what's going on in the market. And so I adjusted the volatility, but I do believe volatility will come back. 2019 was fantastic, but is now in the rearview mirror. Let's fast forward to 2020, 2021. I would say the primary thing is high volatility, growth stocks that we believe in, right? Stocks that for one reason or another, we just believe in that we believe in the path to profitability. We believe in the kind of what they do, as a stock within that space. US Steel is just my favorite. I mean, this list was created for US Steel and AMD, but US Steel is just my favorite. It's my favorite steel company, and it has wonderful cash flow, and it's a high flyer. It can shake people out, no doubt about it. This list is not for the faint of heart, by the way.
No, not at all. I mean, and
this list is not for retirement accounts.
No,
this list is for cash flow accounts, right? The question I have for you and Noah, I want to get your take on it because, Pinterest, I think Pinterest, short-term volatility aside, has a path to profitability. People go to Pinterest for marketing. They don't go to Facebook for that. They hate it.
That's right.
They don't go to Twitter for that. They hate it. But they go to Pinterest for marketing. Yeti, you guys just talked way too much about Yeti. And then I talked to my wife. She loves Yeti. And then I looked into the stock and I love the stock. So there's Yeti. Roku, that's you, buddy. That's your convincing. Yeah. So if Roku doesn't work out next year, guys, you know who to blame on this one.
Listen, I'm a believer. I'm a believer.
I have my GoPro. You might have your Roku.
And Yeti. I love Yeti too. I love all these names, by the way.
Zoom. We're on Zoom right now.
Yeah.
Right. Like Adobe Connect was the one that kind of started it all. And what was it? Black. I can't remember the company. A lot of universities use it. Zoom is so simple and so easy to use. And I just think it's so much better than what Adobe's doing. And so Zoom's one of those companies we obviously believe in. Lyft, they fit the space. They fit kind of the gig economy. I like Lyft more than Uber, but I don't like anything that's happening in either one of those companies right now. Wait for the volatilities to subside, but I do believe one of those is going to be really, really good long term. Slack. I mean, this is my belief. I believe Slack is changing the way corporations communicate. That's what I believe. I mean, guys, I hate my email. I utterly hate my email. Because why? Because you get a million different things you don't want to get, right? I woke up today, Tim, and I had 120 emails in my email inbox. And guess how many of them were legit?
Dude, it happens all the time. I see it all the time with students as well. They'll pull their laptop up. I'm mentoring them. I'm coaching them. I'm like, you have 5,000 emails? What's going on here? Just delete it. Let's get a new email. Let's start fresh or something like that. But that's one of the things. Slack though, and we use it internally for communication. You can go to Slack and you can get your work done. I mean, it is a wonderful, wonderful product. And by the way, I know the Microsoft fans are out there like, oh yeah, we've got this version 2, Teams or whatever. Yeah, that's why the Microsoft is on the Tackle 25K. Slack, they can both exist. I mean, you can have a lot of good companies exist in the same kind of realm. I got to tell you, I love all those names. Momo next here, Matt, Chinese company. Slides back into the dirty, sexy money list here. And it just has a lot of growth potential on this company.
I agree with that. And then, what do we say about AMD? It was the best performing stock in the S&P 500. It's got a high valuation right now, just given what's been going on. I mean, it's got a P ratio at 196 and a PEG ratio at 5. And that's why you don't put all your money in AMD, because it could be cut in half in a week.
Yeah.
Right. So these companies are growth based that we believe in. People use it for a variety of different ways. I use it for boomerangs is what I use it for. I think that's how Mark will use it for. Actually, Mark might just say, I'll do boomerangs on Dividend Fireworks and take my 1% and walk home. So those
You know
are the
who does
lists
a lot of AMD as well? And I think it's because
our entire community.
everybody, but Sylvia actually told a wonderful story on the podcast about that one, where she did that for her steward account for her grandson, you know, where that's all she's doing is like,
Oh, she's doing boomerangs for the, yeah.
boomerangs on AMD, you know, there's a lot of great ways you can play these lists. And by the way, the spreadsheet we had converted with our power team on the back who makes everything look pretty, they actually built this PDF as well, Matt, so people can download this and print this off and actually just have it right there on their desk. And they can get that right on that post, I believe. There's a lot of factors that go into it. One thing I really love about the process, Matt, is that, you know, as you kind of lead the team through the process, you always bring in Noah and Gino and Mark and myself and get input. And then that refinement of where we go from the big list to a smaller list, then discussion, then debate, and then really looking at it through a lot of different lenses, then we finalize the list, you know. And by the way, it's not a final for the whole year. If there are extreme things that do happen, and we did have one stock we had to remove last year, you know, we'll do that on a quarterly basis where we'll evaluate it. We don't make a lot of changes though, Matt. And when we do make changes, we always document them. You know, we put it out there and we really can very much hang our hat on our record on this one. We've had that list out there, what now, 5 years? And it's had a really—
I can't remember if it's 14 or 15. So I can't—
I don't— 14 list. Guys, Happy New Year. Great job tonight, man.
Yeah, Happy New Year, everybody.
Happy New Year, everybody. We will see you guys on Thursday. We'll be back with live content. We're actually taking tomorrow off at Tackle Trading, so we don't have any content tomorrow. But Thursday morning, we're going to be back with the